At around 8:30 p.m. on the 10th of December 2008, Bernie Madoff walked into his apartment and told his family something close to this: "I'm running a Ponzi scheme and we're out of money." The next day, the SEC filed a complaint alleging a fraud on the scale of $50 billion, and on paper, account statements showed nearly $65 billion in investment value, with roughly $17 billion of that being actual customer principal. Here's the uncomfortable lesson: most people didn't lose money because they were stupid. They lost money because incentives bent their judgment. Punchline: if you can't name the incentive, you're the incentive. This channel is decision training for investors. No stock picks, no price predictions, no hype. And before we go any further, here's your 10-second circuit breaker. Screenshot it. Use it when emotions are loud. Checklist library number 07 incentives. 10-second circuit breaker. If any of these hit, you walk away. Can't name the incentive, walk. Guaranteed market. Beating returns, exit. Someone gets paid when you say yes, pause. Then walk, say it out loud. If I can't name who gets paid, I don't play. Now let's earn the deeper understanding so you can spot the trap before it feels like a trap. Picture this. It's 11:47 p.m. You're scrolling. A creator says, "Not sponsored." Then drops an affiliate link. A trading app flashes confetti after a trade. A newsletter screams last chance. A friend texts, "Everyone serious is already in." Nothing illegal has to happen for you to get played. The incentive just has to be strong enough to buy your attention. Today's claim, stated precisely, is this: incentive cause bias is an upstream killer. It hides inside scams, bubbles, overtrading, and too good to check stories. It's not the only reason investors lose money, but it's one of the biggest reasons smart people ignore obvious red flags. Incentives don't need to change your IQ, they only need to change what you notice. When incentives are involved, three things happen. One, attention gets bought. You stare at the upside because it feels good. You skip the boring questions because they feel slow. Talk becomes expensive. If you admit the story is fragile, you might lose status, a commission, a relationship, or a dream. 3, you outsource thinking. You lean on authority, a brand name, a friend who knows a guy, a charismatic founder, because it reduces anxiety. That's incentive. Cause bias in one sentence. Your brain protects the payoff, not the truth. Let's define it cleanly. Incentive. Cause bias is when a person's reward system makes them systematically misread reality, even when the facts are available. It shows up in financial advice and commissions, paid reviews, and affiliate marketing platforms that profit from activity, and most dangerously, your own need to feel smart early and right. Now we'll use one public case as a training ground, not because you'll meet the next Madoff, but because you'll meet the same incentive structure. Scene: imagine you're an investor in the early 2000s. A friend invites you to something exclusive. Steady returns, quiet, confident, no drama. And then comes the social pressure line. Everyone serious is already in. Now watch the incentives one layer at a time. Layer 1, the operator's incentive. If you can keep money coming in, you can keep the illusion alive. A Ponzi scheme survives on confidence, not performance. Layer 2, the middleman's incentive. If you're a feeder, a middleman who brings clients, you get fees. And if clients are happy, they don't ask hard questions. So the middleman is rewarded for keeping the story smooth. Layer 3, the investor's incentive. If you admit something is wrong, you lose your special access to your identity as a smart investor and the comfort of predictable returns. So what do many people do instead? They defend the story harder. Layer 4, the institution incentive. Big names don't like admitting they missed something obvious. Gatekeepers don't like losing a profitable relationship. And yes, even systems can be slow to act when embarrassment is on the line. Then the clock runs out. On the 11th of December 2008, the CC publicly charged Madoff and his firm and sought emergency relief, including an asset freeze. And when you look at the numbers, the scale of belief was enormous. Account statements showed nearly $65 billion in value, with about $17 billion as principal. This is the part people misunderstand. The fraud wasn't just one man. It was a system where incentives made skepticism socially and financially costly. Training takeaway: when doubt becomes expensive, people stop doubting, even when doubt is the only rational move. Now, we add Model 2 base rates. Base rate thinking asks, when something looks like this, how does it usually end historically? You don't need perfect data. You need the habit of comparing patterns. Here are base rate prompts that prevent delusion. How often do steady returns with low drama turn out to be real without transparent verification? How often does secrecy protect an edge versus protect a lie? What happens to fragile structures when withdrawals spike? In crises, base rates get brutal. When fear rises, withdrawals rise. When withdrawals rise, weak structures collapse. So base rates are not cynicism. They're refusing to treat your situation as magically unique. And here's how you keep this honest. If you can't point to at least one comparable historical pattern, your confidence isn't analysis. It's theater. Third model: invert and put the downside first. Instead of asking, how much can I make? Ask, what must be true for this to be legitimate? If you can't list those conditions, you're not investing, you're wishing. Then ask, what breaks if I'm wrong? Not, will I be slightly embarrassed? I mean, what breaks financially, emotionally, reputationally? This is where most people fail. They can describe the upside in poetry, but they can't describe the downside in plain numbers. Now the part that gets saved and shared. This is checklist library number 07. Incentives, 3 hardness levels. A10 second circuit breaker. Recap: can't name the incentive walk. Guaranteed market, beating returns exit. Paid when you say yes, pause, then walk. B30 second entry filter. Add thresholds. If you still want to proceed, you earn it. 20 second test. Explain it in one sentence. Fail equals pass. Downside test. Write one scenario that ruins your lifestyle or sleep. If yes, no position. Exit first rule. Write your exit condition before entry. No exit, no entry. Emotion rule: if you feel urgency, envy, or panic, wait 24 hours. This isn't about being hard to manipulate. See New deep check. Verification plus incentives. Map if money is meaningful. Do the deeper scan. Base rate check. Name one comparable historical pattern. Can't name one equals pass. Second order effect. If you're wrong. What else breaks? Debt, relationships, reputation, sleep. If the answer is a lot. Incentive map 3 lines. Who sells it, who verifies it, who suffers if it fails. If seller and verifier get paid by the same outcome, treat it as a red flag. Boundary matters. This checklist is not enough when you're dealing with deep technical systems. You truly don't understand complex derivatives, opaque private deals, or anything where verification is impossible. In those cases, the correct action is simple: pass and one more boundary. This doesn't prevent every loss. It prevents the losses that come from being played by incentives, including, this is not financial advice, it's decision training. Comment your one sentence explanation of the next opportunity tempting you. Use this format. 1. Who gets paid? 2. What's the downside? 3. What would prove you wrong? If it's not clear, you don't own it. Next episode, we'll run checklist library number 08. Downside, first on a public case with a clean timeline and a hard number.